how would you best hedge any geopolitical tension?
Well, I think we had a relief rally now over the last couple of hours, which is a positive, of course, but I think we're not out of the woods. So there's still risk, and particularly on the geopolitical side, something very difficult to hedge. We remain positive on equities, but we do think some of the hedges that you can consider is, of course, going long oil, being long commodities, because we do think this is a trade that should work in the base case, but particularly in escalation of the Ukraine crisis. That should be a positive one. And then looking for other assets like safe haven assets like the Japanese yen, we do like versus the euro, for example, which would be definitely one trade to hedge, particularly the Ukraine crisis at this point.
To your point, really, commodities across the board rallying, whether it's oil or grains, right, really leading to those inflationary concerns and perhaps a little bit of concern about what's happening with food prices as well as we continue to see those soaring. Do we need to hedge at this point potential social unrest risk as well? And how would you do that?
I do think this is definitely one of the risks we should actually monitor, and it's probably not on many people's radar at the moment, but we should not forget that we had similar episodes over the last 10 years when food prices are going up, that particularly in emerging markets, that there will be unrest, social unrest. And particularly with the Ukraine crisis, this is a clear risk. Russia produces 20% of wheat globally, and we already start to see some impact in some of the emerging markets as food prices, as you can see also on the chart, are actually going up. So definitely the easiest way to hedge, of course, is going long commodities, a broad index which combines agricultural goods as well as metals and of course energy. That would be the easiest way. And then the other way would be to be a bit more cautious in some of the emerging markets that are clearly exposed to this risk, in particular also via the currency side.
Adrian, there's so much enthusiasm and the consensus seems to be that China is actually a really good way to hedge if you're worried about a Fed misstep and developed markets. Do you see opportunities there, and do you see gains materializing that some of these forecasts are really looking at?
Well, the interesting one, China has outperformed globally year to date, but it also comes off the back of a very poor year last year. On the offshore market, we are still neutral. We still would like to see a bit more progress particularly on the housing side, which is still a constraint, and some of the growth numbers are bottoming out, but maybe it could be a bit more forceful. I think there are good elements why China could start to be a stronger performer over the next couple of months, particularly if you sort of look at credit stimulus, which is bottoming out and should start to accelerate. It has derated a lot. And earnings growth is actually set to also start to re-accelerate again as global growth, and particularly Chinese growth is sort of coming back, and that could be a positive one. But as I said, there's still also a few headwinds on China, which we should not ignore. What we have done in our portfolio, we went long the onshore market, which is more directly benefiting from the easing that we actually see from the PBOC, while other central banks like the Fed are going to hike.
We've seen a return of volatility when it comes to the FX market. Are geopolitics the true driver of this? Is there something else at play here? And how do you utilize that to get some of that alpha that perhaps you're not getting from equities?
Yeah, I do think this year will be less of a beta year. It will be more of an alpha year. So we also have started to position portfolios for that. I think what we see in terms of the FX volatility is particular divergence in central bank policies. And that's something that you actually can easily capture via the FX market. So you have clear central banks which are already in a hiking and tightening cycle, including the Fed with the tapering and the interest rate hike that we expect in March. The BOE, for example, another bank, and the RBA. And then you have other central banks like the ECB, the SNB, the BOJ, which are probably lagging this interest rate hiking cycle and also the tightening side. And so there will be currency diversion. And I think that's something we started to position and we started to catch up in our portfolio.